We don't talk much about the wars in the Middle East. This is bad money, not mad geopolitics. Last week, a coalition of nations led by the United States started a bombing campaign against the Houthi rebels in Yemen, a militia group backed by Iran that's been fighting the Saudi-backed government for years. But our government never got involved until the Houthis started attacking commercial shipping in the Red Sea. There have now been 34 attacks, including one that occurred earlier today. Anything that can shut down shipping in the Red Sea will have an impact on your portfolio. See, the Houthis are going after a key commercial shipping route that connects the Indian Ocean to the Suez Canal in Egypt, which then leads to the Mediterranean. Because these attacks have been so indiscriminate, some of the largest shipping companies in the world have halted Red Sea shipments entirely, which means they need to detour around the Cape of Good Hope at the southern tip of Africa. According to industry estimates, Suez Canal crossings could drop by 40 to 50% thanks to these rebels turned pirates. Why does that matter? Because rerouting ships across Africa around Africa, when you go down all the way, takes a lot more money than it does to go through the Suez Canal. That's why they had to build the canal to begin with. It's way more expensive. So we've seen a surge in shipping prices for many global trading routes. The price to ship a 40-foot container from Shanghai to New York, for example, is 121%, up 121% since late October. Most routes to Europe have seen even larger spikes. Shanghai to Rotterdam is up 393% over the same period. While the Red Sea doesn't have as much impact on our West Coast ports, it's still going to hurt because day rates for all these vessels are going up, and we might even end up with a container shortage. So what should you do about all this? Now, you might think it's a good idea to buy the shipping stocks. One of the great ironies, though, of the situation is that the Houthis' attacks in the Red Sea could put an end to the global shipping recession we've been stuck in for most of the year. That's not past year. That's not bad. But as I always tell you, the shipping plays are really only good for the occasional trade. They're too volatile to be good investments. I don't recommend them because of that, because they are boom and bust. And even if you wanted to buy them now, the attacks have been happening for weeks, so you're already late to the party. ZIM, ZIM Integrated Shipping, for example, it's jumped 115% from its lows less than 2 months ago. Could it keep running? Maybe. But in my view, this industry is a total crapshoot. I'd rather make a bet on DraftKings. What about the pin action from the Red Sea turmoil? With ocean freight rates rising and transit times getting longer, many retailers may be forced to use air freight instead, and that'd be great for FedEx. When FedEx reported a disappointing quarter last month, the big drag on their business was competition from much cheaper ocean freight. Now that dynamic's reversing itself, so the international express business could rebound. There's lots of other businesses they have, but I like that. And, I like the stock of FedEx. How about the rails? How about this one? Earlier this week, analysts at Redburn Atlantic recommended Canadian Pacific Kansas City because this railroad has basically created a land bridge from the west coast of Mexico to the east coast of the United States. That's extra attractive at a time when the Panama Canal is suffering from a drought that's imposed severe traffic limits. I could also see Union Pacific winning here if more shipping gets diverted to the West Coast. They're the go-to railroad for our West Coast ports. But honestly, when I see how this Red Sea turmoil is pushing up shipping costs, my biggest fear is that it's a huge setback for the Fed in its fight against inflation. For weeks, I've been warning you that Wall Street got way too bullish, way too complacent, with the federal funds futures reflecting 6 rate cuts this year. At the December Fed meeting, they only floated the idea of 3 rate cuts. I'm with the Fed, 3 rate cuts. But with shipping rates soaring, even 3 might be on the high end of reasonable. That's rough for the stock market because so many investors need to adjust to a reality where the Fed's a lot less friendly than they expected. When I laid this out a couple of weeks ago, I told you that a flare-up in inflation could be a wake-up call for the market. Since then, we've had a too-hot December consumer price index reading, hotter than expected retail sales yesterday, and the yield of the 10-year Treasury has gone from 3.91 to 4.14. So I argue the flare-up in inflation may already be happening. Now, think about what a drastic increase in shipping costs will add to the equation. Throw in what Carly Garner told us about oil prices last Thursday night. She thinks West Texas Intermediate crude is likely to be headed back to $100 a barrel, with oil already up nearly 3% in a week since then. I'm not going to doubt her. In fact, these two issues are actually related. Given the Red Sea's proximity to so much of the Middle Eastern's energy production, well, these shipping issues could push up the price of oil all by themselves. Crude gets more expensive when you just can't safely use the Suez Canal. Just this week, the CEO of Shell told the Wall Street Journal that his company has already suspended all shipments through the Red Sea, leading to a 5 to 10% increase in the cost of delivery thanks to the extra travel time. BP made a similar decision last month. Qatar's state-run oil company also announced plans to stay out of the Red Sea this week. Every time you see one of these headlines, it represents a small setback in the Fed's fight against inflation. Hey, put them all together, and all I can say is you're wait for rate cuts? Well, I say don't hold your breath. When you see a situation like the Houthi attacks on merchant vessels and the corresponding increase in shipping rates, try to think about what that means, both directly and indirectly. Right now, I don't think you should be chasing the shipping stocks. It's a bit late for that. I'd rather own some other transports, again, like FedEx or Canadian Pacific Kansas City, both of them very good. They're not going beneficiaries from ocean shipping disruptions. But the bottom line, if the last few years have taught us anything, it's that supply disruptions are the bane of the Fed's fight against inflation. And if ships in the Red Sea aren't safe, that's a major disruption, meaning you simply can't expect as many rate cuts this year because the cost of freight's suddenly gotten too expensive. And the cost of freight flows through the cost of pretty much everything. Mad Money is back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.